Ever wondered how traders make decisions based on complex charts and seemingly cryptic indicators? One such tool at their disposal is the Bollinger Band strategy. A fascinating concept that might seem intimidating at first, but with a little bit of understanding, it can open up a new world of trading opportunities. The Bollinger Band strategy, named after its inventor John Bollinger, is a technical analysis tool designed to measure market volatility and provide relative definitions of high and low prices. It's a strategy that has been in use since the early 80s and has stood the test of time in the ever-evolving world of trading. Imagine a simple moving average line running through a price chart. The Bollinger Band strategy adds two lines, or bands, above and below this moving average. These bands are standard deviations that adjust to market conditions. The upper band represents overbought conditions, while the lower band indicates oversold conditions. The Bollinger Band strategy operates on three key principles: the squeeze, the reversal, and the trend. A squeeze occurs when the bands come close together, indicating a period of low volatility. Traders view this as a potentially significant period, as it often precedes sharp price movements. Reversals come into play when the price touches one of the bands. If the price hits the upper band, it could indicate that the asset is overbought and may be due for a price drop. Conversely, if the price touches the lower band, it might suggest that the asset is oversold and could be gearing up for a price increase. The trend is a principle based on the direction of the Bollinger Bands. If the bands are tilting upwards, it could indicate an upward price trend. If they're tilting downwards, it might suggest a downward price trend. To sum up, the Bollinger Band strategy is a dynamic tool that measures market volatility and provides relative definitions of high and low prices. It operates on three principles: the squeeze, the reversal, and the trend. The squeeze highlights periods of low volatility that often precede significant price movements. The reversal principle suggests potential price reversals when the price hits the upper or lower band. And the trend principle uses the direction of the Bollinger Bands to indicate potential price trends. Remember, like any trading strategy, the Bollinger Band strategy isn't foolproof. It's essential to use it in conjunction with other indicators and strategies to increase its effectiveness. Understanding and mastering this strategy can provide valuable insights into market conditions and potential trading opportunities. So, with a bit of practice and a keen eye for detail, you may just find the Bollinger Band strategy to be a game changer in your trading journey.